Hello, clients and friends of MVP Sterling Partners. It's Jamie here with a Q3 market update and an outlook into the end of the year. Have a look at what we're going to do today. We're going to talk about how Q3 progressed in the markets. We're going to have a look at the interest rates outlook in the Bank of Canada and the Federal Reserve, a little bit of an economic outlook, and then we're going to have a quick talk about cash management. So let's jump in. Let's take a look at the broad markets. You can see a lot of red here for global equities and bond markets for September. Year to date paints a little bit better of a picture, but those rate sensitives like REITs and bonds have actually shown another negative year so far in 2023. When we look to the internals of the TSX and the US equity markets, we can see some sectors have turned out positive returns year to date. Technology in particular stands out, but Q3 was negative across the board. Energy was the only bright spot for the third quarter. So really that rise in interest rates has taken its toll. So let's have a look at rates. As we can see here, the 10-year Canadian bond yield is turned upside down there, an inverted curve to show that as interest rates rose, in this case the line fell, it also saw the real estate and utilities sector falling along with it. When we look further into the Big Seven theme, everybody's heard about these Big Seven names: Apple, Microsoft, Amazon, Meta, Google, Tesla, and NVIDIA. They still represent a huge portion of the S&P 500's year-to-date return. Of the 13% that the S&P has risen year-to-date, 11 of that is due to those seven names. And the rest of the index is more or less split, although slightly skewed to the positive side. So 6.8% return attributable to the winners and negative 4.8 to the losers to net out for 2. And that's how we get to 13.1 for through Q3 of this year. Well, let's go on to rates. Are we at the top? Well, the market thinks so. The expectations for the Bank of Canada and the Federal Reserve have more or less topped out. We might see one more hike. There's a little bit of a possibility priced in over the course of the year that the Fed and the Bank of Canada will raise once more. But for the most part, this is the first time that we've seen since March a flat and neutral interest rate outlook. But this is the really big change. What has happened down the curve is the length of time that the market expects the banks to stay at these interest rate levels has increased dramatically. And this has caused longer term bonds, 5-year and 10-year bonds that we're looking at here, for their yields to rise dramatically over the course of Q3. And actually, this started in Q2, but really started to accelerate and gain momentum as we headed out through the end of September. So longer term rates are resetting. The market is coming to appreciate that perhaps inflation could be higher for longer in a scenario where employment has remained strong and inflationary measures like CPI seem to have stopped falling. So as you can see in the bottom right corner here, the CPI measures for Canada and the US have hit a bottom as of late, and they've been bouncing around here. And that's caused, as we just saw, the longer term bond yields to rise. And the yield curve, as we've seen from 2-year to 10-year, start to narrow. Now, this is quite strange. Normally, we see the yield curve inversion right itself through the Bank of Canada and the Federal Reserve lowering interest rates on the short end of the curve. But right now, what's happening is it's getting less and less inverted. So we're getting towards a flat curve, and that's been due to longer end yields increasing. So what's the outlook for the economy, given that we're seeing bond yields out at the long end raise a lot? Well, consensus is still for a soft landing. As you can see here, we've gotten the potential outcomes stratified here by best to worst, top to bottom, and the size of the bars on the left are the probability of those types of events. And this is current consensus. We will thank Dynamic Funds and Payden and Rigel for this view, and this reflects their views, but also consensus views of the market that a soft landing is the most likely outcome right now. What will that mean? Well, it'll mean unemployment rates rise very slightly, core inflation stays around where it is, and that is probably going to be a positive view for equities and a neutral view for bond yields from where we are today. Now, a no landing scenario, meaning the economy just chugs along, that actually would likely be negative for equities because it would mean that unemployment stays strong and the Fed and the Bank of Canada would likely get back into a rate hike regime as core inflation would stay elevated well above their targets of around 2%. On the bottom end, a bumpy landing or a hard landing in which we see actual GDP contraction and larger rises in unemployment, so less employment, more layoffs. Those would be negative scenarios. As on the equity side, it would likely mean that earnings would be revised lower, and that's how we get to negative GDP. We get negative earnings, and GDP would end up declining. Into the year end and beyond, we see a little bit of a divide between market indicators and economic indicators on the outlook. As you can see here as an example, job openings remain very strong. The chart on the top left here shows job openings in the US both before and after the pandemic. And as you can see, the need for workers remains very high, much higher than pre-pandemic levels. And yet, the chart below that shows the S&P 500 staple stocks divided by luxury goods. So when that line is rising, it means that the market is getting defensive and preferring staples over luxuries. When we look at the economic indicators, fundamentals seem strong. Earnings, both in Canada and the US, as measured by EPS growth, remain very good, whereas the economic indicators are mixed. Leading indicators are weak. Recession probabilities, according to the New York and Cleveland Feds, actually remain pretty negative. But there's some strong signs, the previously mentioned employment, even housing starts are starting to pick up. So we've got a bit of a mixed bag in terms of what we're looking at economically. What about valuations? We always like to look forward and see what kind of investment environment we're into. Well, valuations have actually looked pretty decent. For the first time in 20 years, the bond market relative to stock market is actually looking cheap. So bonds are cheaper than stocks. This hasn't happened since 2001. So it's been quite the change and quite the bounce back. And this is largely due to bond yields rising. As we know, when bond yields rise, it's not fun to own bonds, but it does make for a much better entry point, and we're seeing that in the market right now. The S&P earnings yield, which is simply the price earnings ratio inverted, earnings divided by price, and bond yields of the aggregate corporate market in the US have come to be about equal, and that historically has been a good entry point for bonds relative to stocks. Seasonally, we're getting into that time of year where stocks like to rally. So this chart shows the average monthly return for the S&P 500 and the TSX Composite Index. Those are the gray and orange bars respectively. As you can see, August and September historically have averaged out to negatives. And the little dots there indicate how often we see negative outcomes. This is over a 36-year period. So you can see September is quite often, in fact, more than 50% of the time, September is a negative month. But we're getting into the seasonal part of the year where equity returns tend to be better than the rest of the year, and the instances of negative outcomes decline. In fact, December has the lowest incidence of negative outcomes for the S&P 500 and the TSX at 20%. So that's a positive outlook from a seasonal perspective in terms of equity investing. We've mentioned it before, but we'd like to remind everybody, cash is king. We can get very good yields on cash right now. So to the extent that there's any cash lying out there that's not earning interest, one of the consequences of an inflationary environment is that that cash loses its purchasing power faster. So we'd encourage you to get it invested into safe, stable, liquid cash instruments that earn between 5 and 6% that we're seeing now. So give us a call for more information on that. We'd love to help you out. That's about it for Q3. So thanks everybody for joining us. We look forward to connecting with you soon.